Hi, everybody out there. My name is Abby Bauer, and I am an associate editor for Hoards Dairyman magazine based out of Fort Atkinson, Wisconsin. Want to thank you for tuning in to today's webinar, which is titled The Dairy Situation and Outlook for 2019. Hoards Dairyman and the University of Illinois have been co-hosting these presentations for the last 8 years. Our team consists of Jim Baltz at the University of Illinois and our Hoards Dairyman online media manager, Patty Hurchin, who do all the behind the scenes work to make sure everything runs smoothly for these monthly presentations. This month's webinar is sponsored by Chris Hansen, a global company that produces an array of science-based products, including probiotics and silage inoculants used by our dairy producers. We're very pleased to have their support of this program and thank them for sponsoring this particular webinar. For all of you that are listening to the presentation live today, you have access to the slides that Dr. Stephenson will be presenting from. Those PDFs can be found in the handout section of the GoToWebinar. If you go near the bottom of that control panel on your screen and click on handouts, there's an option to print those 2 PDFs there. So that gives you an opportunity to have the slides to look at later, or if you want to take notes on them, feel free to click on those and you'll have the handouts for your access later on. Today, I have the pleasure of introducing our speaker, Dr. Mark Stephenson. Dr. Stephenson is the Director of Dairy Policy Analysis at the University of Wisconsin-Madison. In his position, Dr. Stephenson conducts and coordinates research and outreach activities related to the dairy industry. He's involved in applied research at the farm level, including milk assembly costs, processing costs, new processing technology, farm costs, and price risk management. He's also active at the sector level, including dairy policy, milk pricing, international trade, and milk price forecasting. He also has a second title as the Director of Wisconsin Center for Dairy Profitability, and in that role, he works with faculty and staff to coordinate a multidisciplinary approach to farm-level problem solving and planning. Dr. Stephenson is originally from Michigan, and he received his bachelor's and master's degree from Michigan State University in dairy science, and later he earned a master's and a PhD in agricultural economics at Cornell University. And we're glad that he headed out west and came to Wisconsin to share his expertise here. So Dr. Stephenson, we welcome you to today's webinar, and please go ahead.
Well, thank you, Abby. And yes, I am pleased to be here. It's not a bad winter's day, and I welcome everybody that's on the webinar this morning or this afternoon, depending on where you are, I guess, in the country. I do want to cover the dairy situation and outlook. And for the dairy situation and outlook this year, we're going to go back and look at the what's happened in 2018, because usually what's happened during that period of time gives us a trajectory for where we think 2019 is likely to go. And I'll try to tell you some of the things that I think are likely to be an impact. I want to start off with just a couple of slides on our general economy. Our general economy has been strong. One of the ways we look at this is by something that's referred to as the unemployment rate. And you can see that we're clear down at a level below 4%. In fact, the last 3 months have been at 3.7% unemployment rate. This is in an area or territory that historically we would call full employment in the United States. So most people who are looking for jobs can find them, and I've certainly heard a lot about from folks who are looking to employ people that are having a difficult time trying to find that employment. Now, there's always been a question, I guess, in the last couple of years about whether or not the salaries have been commensurate with this low unemployment rate, but we have seen even salaries climbing a bit as well. I wanted to focus on another couple of measures of the general economy. These are some that maybe we don't talk about too much, but I bring them up because I think that they have been very good forecasters of downturns in the economy as well as upturns. And there are 2 of these measures here. One of them is a ratio of household wealth to income. And those 2 things are different. Wealth is really talking about the value of assets. That tends to include stock portfolios, real estate. that type of thing. And the other, of course, is income, what you actually earned over the course of a year. And that's being shown in the blue line here. Usually, if wealth starts to outgrow income by a significant amount, then we find that we're in some problems, that it's only the people who generally have wealth or a fair amount of assets that are feeling good about the economy, and those who are being left behind with incomes relatively low are not. And the other measure that I'm showing in the orange line here are the ratios of a short-term interest rate, a 2-year rate of interest, relative to a 10-year rate of interest. And it's good if our long-term interest rate, the 10-year rate, is quite a bit higher than the short-term rate. If those two things are starting to come together, it's a general indication that we feel good about our present economy, but not so good about the future one. And we like to have a strong 10-year rate that gives people optimism about the future. You'll notice that in this slide, these time periods that we've had, where we've been looking at maybe the year 2000 or so, on both of the trends or charts, we would see that they have been sliding down, and that presaged the gray bar that's showing you the recession that we had in 2001. And you'll also notice that similar kind of thing happening in 2006 and 7. Those were both in decline, and when they just started to turn around and move themselves back up, we found the U.S. economy in recession once again, and this was a deep recession. Well, those rebounded, and we've had good measures of the economy over this time period, but I think you can see clear over on the right-hand side of the graph that these are now at pretty low levels. And in fact, it looks as though our ratio of wealth to income is starting to turn back up, and we're believing that we might see the same sort of thing with that 10-year rate versus the 2-year rate. So I'm a little bit nervous about the general economy and whether or not we may be slipping toward recession. When we look overseas, we actually see major countries of the European Union like Germany, France, and Italy that all are pretty close to being in recession. Technically not there yet, but they've actually had a negative growth on their industrial manufacturing, which is a pretty good indicator for them that they're almost there. And if we start to see some of these things unraveling, then we could see recession here at home. Now, it's not unusual for us to move into an economic downturn, especially after having a decade of strong economy and strong growth in that economy. So something like that may well be in the cards, but it's not going to be good for dairy if it happens. It never is. This is one more chart that tries to relate a little bit more closely to dairy. We've often heard in monthly reporting in the newspaper about consumer confidence. And the consumer confidence that is being talked about is the orange line that's kind of in the middle of these other two lines here. Consumer confidence is actually the average of two sets of questions that they ask ordinary people. They make phone calls and they ask them, how are you feeling about the economy today? That's the present situation, the red line. They also ask them a set of questions about how are you feeling about the economy in the near-term future, maybe 6 months from now. That's the blue colored line. If you go back and look at 2006 and 7, you can see that the present situation, consumers are feeling much better about the economy than they were for their expectations. So in other words, if you ask them, they might say things like, boy, my 401k is really strong. Stock market's doing great. I feel good, but I'm concerned or I'm nervous about the future. And in an economy like ours, where much of our gross domestic product is generated by consumption, if you start to become concerned about the future, you get conservative about your expenditures. You want to save some money. And when that happens, we fall into a tailspin and a recession like we were in 2009-10. Now, during that time period, you'll notice the present situation in the red was clear down at the bottom, very low, historically low, in fact, for this survey. But consumers were saying, I'm optimistic about the future. And over time, they began to pull themselves up and out into the current kind of economy we had. I'm talking about this because you can see now in our present time period going into 2019 that this spread between our optimism about the current situation and the future is getting to be quite divergent. And that's often a time period when consumers begin to get conservative about what they buy. Maybe they don't go out to eat as often. And dairy products are prominently featured in out-of-home consumption. That would not be good for our U.S. dairy industry. This is just a chart that's giving you an idea about other countries as well as the United States and where it is that they are generating their gross domestic product, their GDP. You notice clear over on the left, we see the U.S. 71% of our gross domestic product is generated by consumption, which is a high amount, more than any other country that I'm aware of. The UK is next with 66%. But if you look all the way over on the right-hand side of the graph, you see China over there, a booming economy, or it has been for quite a while. And their GDP is only about 34% from consumption. Much of what China is generating in the way of gross domestic product comes from investment. So you have firms that are investing in the future in infrastructure and buildings and roads and machinery, all kinds of things, and not so much from consuming products. Now, there's nothing that's fundamentally wrong about either type of economy, whether it's coming from investment or whether it's coming from consumption, but they do have different outcomes when we have economic downturns. A country like China, with a lot of investment for their GDP, can be more immune to the impacts of recession because they may be willing to spend money right on through a recession for investment purposes and not so much for consumption. So we're a bit more vulnerable to downturns in the economy as a result of the type of economy we have. I want to talk about dairy trade. And in this chart, I've got two things that I'm showing. Over on the left-hand axis, and then the blue line, are exports. And those are being expressed as exports as a percentage of U.S. milk production. And those have been climbing really quite tremendously over time. This is also a rolling 12-month average of exports. I guess I would point that out to you. On the right-hand axis, I'm showing you, and in the green line, the U.S. all milk price. A good indicator of what milk prices are doing across the country. The reason I'm showing you this chart is that I want to draw your attention to every major downturn that we have had in U.S. all milk prices. Those downturns correspond to time periods when our export growth has been off trend or in fact even down. And if you take a look at that 2009 and 10 time period when we had that huge plunge in milk prices, you'll notice that we had quite a drop, a good 2% drop off of exports. And that was exports that weren't going to customers overseas. They stayed home in our domestic economy. Our domestic economy also happened to be in recession, and that really pushed prices down to clear the markets. If you look clear over to our current downturn in milk prices, this has been a long one. It's been going on for a full 4 years now. And while it's not been as deep as 2009, it has been persistent. We've also at the bottom had about a 2% decline in these exports. They are coming back up again now, and I feel good about that. But I don't think that we can have full recovery in our milk prices until we are exporting something like maybe 17 or 18% on a rolling 12-month average. We've had some months that have been up there recently, but the full year's rolling average hasn't gotten there yet. So exports have been impactful as far as the milk price is concerned. When those products aren't being sold overseas, we tend to make products that we can store for some period of time. And one of the first things we see is that our stocks numbers start to grow. Notice here after 2014 that the 2015 cheese stock numbers were showing an increase in that green line over the whole year. 2016 was bigger than 2015. 2017 had a more normal seasonal pattern of increases through the flush season, but it was still bigger than the year before. And finally, in 2018, we were holding the line pretty well, maybe even working stocks off until we got to about September. And September, the fall time period, is the time period when usually we're pulling our stocks down as we're drawing on the product that was put away in the flush season of the year. Our big consumption season is from Thanksgiving through Super Bowl. And so it would be normal for us to be pulling stocks down, and instead we're adding to these stocks in a pretty big way. That's why we have such a depressed price right now. These things have caused our milk prices to be range bound. This is again is the U.S. all milk price, and you can see where it's been over the course of not quite a decade, but getting close to it. And we've been in this $16 to $18 range for 4 years now, moving into our 5th year. And we are not likely, in my opinion, to see those prices get to be up in the late 2013 and 2014 ranges until we work these stocks down and until we start to see a bit more product sales happening overseas, or unless we see milk prices contract, or milk supplies contract quite a bit more. So this is where I would like to pose a set of poll questions to you. You as producers and those of you who are working with producers, I'd like to see if you wouldn't be able to answer a few of these questions for me. Just pick one of them. They kind of indicate a range of options from it's really bad to it's not so bad. In fact, there's some opportunities right now. Just let me know by your polling where you fall into that range.
Very good, Dr. Stephenson. Once again, this poll question, no right or wrong answer, but just assessing the dairy industry out there. So whether you are a dairy producer or you're working with farmers, kind of what's your take on the industry? How are you feeling about things? Well, we have a nice live audience out there, so we will let a few more of you chime in with the vote. Please do that. It's an opportunity to give your opinion and be a little more interactive in these presentations. So we like to have a few poll questions as we go along. All right, Jim, I think we can close the poll now. And once the answers pop up, we'll let Dr. Stephenson just take a look at those. And if you have any comments, and then feel free to continue on.
Oh, I think this is very interesting. I would have a few comments, and this is falling in line with a nice distribution, I guess, on there from the I'm desperate, I'm not sure I can make it through. Not quite, but nearly 10% of our viewers feel like they're in that category. 17%, are saying I'm still creditworthy, but I don't know if I want to be in this business at this point in time. Might sell the cows. And if you look at the modal answer, the one where we see most people, it's this isn't any fun, but I'm in it for the long haul. I'm going to be sticking around. Other people may be feeling a little bit better about the trough that we've been in here. We aren't replacing much capital that's getting worn out, but we aren't borrowing anymore either. So that just sort of says, I'm doing okay. And then maybe clear at the other end as far as optimism goes. I'm buying some dairy assets. Boy, I'll tell you, cows are inexpensive right now. So if you are looking to buy cows, you can certainly do that. And probably not a bad time for some of the other opportunities like building dairy operations as well, pouring some concrete. And we have been seeing that happening in most areas, but not a lot. So maybe a good time for contractors. All right, I thank you for that poll. That was well worthwhile. Why has this trough persisted out here? Why have we been in this thing so long? And this, I think, is going to kind of connect with the poll that we just looked at. If we're trying to look at this and just say, why has this persisted? We collect hundreds of dairy farm financial records that are filled out by accountants every year, and we have a chance to go through them and to look and see what kind of response we have from dairy farmers. And one of the things that I've always been fascinated with is that there's fully a $10 range every year between the lowest cost farms and the highest cost farms. And I'm not talking about a handful of outliers. I mean like the top 25 and the lower 25%. And that $10 range is really big. I've also had a chance to call a number of bankers around the country. I do that occasionally just to try to ask them, what's your portfolio look like? How are farms doing? And the response that I've been getting has been quite varied. Some banks are telling me, well, it's not great, but everybody's going to get through this. It's okay. To banks that are really panicky. They're saying that they've got a lot of loans that are in trouble and they're concerned about it. But my summary of it is right here in these bottom 4 bullet points. About 20% of the farms have cash flowed right through this trough. So they've gotten through it okay. It's not been as much fun, but it's okay. 30% of farms have had to borrow a bit more, but they're creditworthy and it hasn't been that big a problem. Another 30% was maybe a little weaker on that side, and they've had to borrow against their equity in the farm and maybe had to restructure loans, lengthen them out a little bit longer. And another 20% have been in some real problems. So that kind of is my qualitative assessment of what I hear from bankers about the farms around the country. So how bad is it? Well, Wisconsin is one of the states where we do actually get farm numbers, dairy farm numbers on a monthly basis. We can look at the number of licensed herds. This is not headline grabbing to just look at it and see that we're seeing fewer farms every year. That's been going on since the 1930s. But I think you can tell if you look at the bottom lines in here of 2017 and 2018, that pace of farm loss is clearly up. We are losing more farms than is typical. We can take that same data and look at it in another way. And here I would call it the rate of attrition. And that's what you see here. What's normal for us in Wisconsin is to lose between 3.5% and 4% of our dairy farms a year. And that's about what we had in 2015 and 16. But in 2017, half the way through the year, you started to see that rate picking up. And in 2018, you'll see that it's way up. And in fact, we're above 7.5% now, loss of dairy farms for the year. So it is a bad situation. We are losing dairy farms at a faster rate. I should also say that not all of those are farms that are not creditworthy. We've had a number of farms who have just decided, I'm tired. I don't want to borrow from my equity. That's my retirement. I'm close enough to retirement. It's time to sell the cows. So we have seen more animals moving. Okay, why the long trough in milk prices? Well, I'm going to look outside the US as well. This is a little bit of a busy graph, but let me try to walk you through it. As long as we're exporting dairy products, we have to be price competitive with other major exporters. And the 2 biggest world exporters are actually New Zealand and the European Union. New Zealand shown here in green and the European Union in red line. The US is in the blue line. We are the 3rd largest exporter in the world. And while New Zealand and the European Union export about the same volume of dairy product, the US comes in a ways behind it. There are other countries like Australia, Argentina, and a few others that are exporters. But if you take a look at all the major exporters, I'm showing that in that dashed black line. The European Union had been increasing milk production in quite a strong way for a period of time. In the red line, they were up to about 7% even last year, or in 2017, and much more than that in 2015 when the quotas came off. The dairy farms in New Zealand are much more impacted by production possibilities. So when you're pasture-based system, if you aren't getting rains, or if you're getting too much in the way of rains, then your milk production can be really pretty difficult. And you'll notice that they've had big ups and big downs according to those kinds of years. All of us are facing the same sort of farm gate milk prices, but we choose production for different reasons. One thing I want to point out to you is that all major U.S. all major exporters of the world, that dashed black line, is starting to dwindle down. So there's a little less product on world markets right now, even though New Zealand has had a very strong start to their production year here in 2018. Good rains, pastures have been in good shape. They've been producing a lot of milk. European Union had bad drought last year, 2018, and they are being impacted by these low milk prices. It's taking its toll now. In the U.S., we had increased cow numbers from 2015, 16, and 17, and finally in 2018, we're starting to see the number of dairy cows in the U.S. herd beginning to decline. They've dropped some 30,000 cows for the data that we have. I'm not sure when we're going to get our next report on milk production, which includes cow numbers, because it's not being reported and maybe not being collected while the government is in temporary shutdown. But cow numbers have been declining, so we are starting to see some of this being an impact on farms. Milk per cow per day is the other part of that equation, though, and there's a seasonal pattern to that I'm showing here, but also an increase almost every year. And 2018 has not been too different in milk per cow. Those increases have been about what we would expect, maybe a little bigger than normal during some months, but for the most part, it's not been an unusual year for milk per cow. But you put those declining cow numbers and that increase in milk per cow per day, we are still increasing milk production, but not much. This is what you actually see in terms of the percent change in U.S. milk production. It's ordinary for us to be between 1% and 2%, and we have been there most of the last several years, a little bit above going into 2017, but right now we're actually a little bit below. And I think you can see that the trend over the last 2 years has been declining, but not negative milk production. In 2009, we actually had negative milk production. That doesn't happen often, but it does happen. Ordinary for us to have a moderate increase in milk production. The regions of the U.S. have been making some changes, though. In this particular graph, I'm showing you a comparison over a 3-year time period. So this compares milk production in 2017 to milk production in 2015. There was kind of a diagonal swath up through the middle part of the country, from Arizona to Texas in the south, and North Dakota through Michigan, even New York, where we had strong milk production. And the upper Midwest had really quite strong milk production. The 3 of the top 5 dairy states, which would be Wisconsin, New York, and Michigan, all had strong increases in milk production during that time period. We've seen losses in milk production in the Southeast for a long period of time, but what was unusual for that 3-year time period is that we were seeing losses in milk production in states like California. So losses in milk production out west, growth up through the Corn Belt in the Midwest and on through the south central part of the country. Last year, we don't have all 4 quarters yet, so I can only show you the first 3 quarters of 2018 compared to the same quarters in 2017. It's a little bit different story. Texas has still been growing like crazy, but the Midwest has really slowed down milk production. And we've started to see California actually have a modest increase again, but remember that's off of a loss of milk production earlier. So this has changed a little bit in the past year. We'll have to see how it evolves over time. Southeast is still losing milk production. We've had the strong economy and consumers have been spending money, and they've spent them on dairy products. So consumption of dairy products in the US has been good, and dairy products are actually a good buy. You can see here, this is the Bureau of Labor Statistics index of retail prices for dairy products. 2014 was the peak year. Of course, that was peak year for milk prices for dairy farms as well. That got reflected all the way through to consumers. As milk prices have dropped at retail, so too have, or as milk prices have dropped at the farm level, they've also dropped for dairy products at retail. 2018 has been the lowest year of retail prices that we've seen in about 5 years. So actually more than that, 6, 7 years. So retail prices for dairy products are showing dairy products to be a good buy, and consumers are purchasing them. There are some categories, though, that are really problematic. This is showing you a 12-month rolling average of fluid milk sales. And you can see that it held up okay over a time period shown here in the latter left-hand side of this graph until about 2010. Per capita sales of fluid milk were declining, but population was growing, so they were flat. But since about 2010, we've been in a tailspin, and we have been losing sales of fluid milk pretty dramatically. That's one category of dairy sales. I think we'd have to say, though, it's not all bad news, because if you look over an even longer time period, cheese consumption per capita has really been growing. 1970s, it was about 14 pounds per capita. Today, by the time we're looking at cheese consumption this last year, 2018, it was actually up to about 37 pounds, a little over 37 pounds per capita. That's a lot of growth. I've heard some people say that we aren't drinking our milk anymore, we're eating our milk. And that certainly is reflective of this kind of product increase. I wanted to point out that while there's some place for pessimism with these prices out here, we may have an indication that things are beginning to turn around. This global dairy trade index is an auction of dairy products that happens every other week. New Zealand sponsors that auction. A fixed amount of dairy products are brought to the auction, and they sell them until the auction is just exhausted. And the index of those prices gives us some idea about what the world is thinking of the value of dairy products. You'll note that it's been pretty flat and down since 2015 in comparison to where it was 2013-14. But in the last 3 or 4 trading sessions, we've seen a small uptick. And I put the question mark there because lest we get too excited, you can see little upticks along the way over the last several years, and only to be beaten back down by a decline in prices. But I'm actually thinking that there is some room for optimism, and that maybe what we're seeing in these last 3 trading sessions is genuine, and we might see a little bit more strength in that over the next few months. Part of the reason is that the stocks in the world for some dairy products like skim milk powder is beginning to decline. The European Union had a policy in place that was very similar to our dairy product price support program, in that they would buy some products off the marketplace in order to bolster farm prices. So skim milk powder is one of the products they bought. They started doing that halfway through 2015, and you can see they built up quite a stockpile of dairy powder. And that's just been overhanging the market and would not let prices get out of its range-bound area until they start to be worked off. But the EU is selling those now back to the marketplace. They've reported that they think stocks will perhaps be done or gone to zero, their intervention stocks, by the time they get through the first quarter of 2019. I'm not sure we can be that optimistic, but we are seeing some strength there. I think certainly by the end of the year, we'll be through that. Despite these trade tensions, there's other places perhaps for optimism. China's per capita dairy consumption is still small, and it is expected to grow. It only averages about 23 pounds of milk equivalent compared to the world's average of 111, and the US average is about 640 pounds. Some of the countries of Europe are much higher than that even. But China's small dairies have been exiting even faster than their mid-sized dairies, and large ones are growing, and they've been having some contraction in milk production. Historically, China's bought a lot of product from us. Whey in particular, we are in the process of renegotiating trade with China. That's happening as we speak. But we have stubborn leaders, and it's not easy for us to get there. China, by the way, has historically purchased maybe half the world's whey powder, and the US has supplied nearly half the world's whey powder. If they want whey powder, at some point in time, we are going to have to talk with them, and they're going to have to talk with us. We have had a new trade agreement that has been signed by the leaders of 3 countries. That's the US, Mexico, Canada trade agreement, and it does have a modest improvement for access to Canada over the time period. So mild optimism there, but I'm not looking at that as being the kind of thing that will turn our milk checks around. It's relatively small. But Mexico has actually started to purchase dairy products again, despite the fact that they still have retaliatory tariffs on cheese sales from the US. I've got 3 graphics here. This is from US Dairy Export Council. And the top graph is showing you skim milk powder exports from the US to our major buyers. Mexico, you'll see here, was up quite a lot last month in October. October is the last month reported. Southeast Asia had a big increase. So we are selling more skim milk powder. Cheese exports have also been up. Despite those tariffs, Mexico increased their purchases quite a little bit from South Korea. But, you know, even cheese exports are doing okay. China, though, when you take a look at the whey exports, we are way down. So, you know, we have not been selling the amount of whey products to China that we have typically done. That's something that we need to really change fairly soon. So I have another poll here, and I would like to ask you folks, if we could dial back the clock, maybe to the year 2000, would you want us to be a major exporter in the world? So Abby, maybe you can go ahead and conduct that poll.
Sure can. So there's 3 choices here. Select one of the following, please, for all of you that are out there listening. 1, it was better when we only exported a small amount of dairy products. 2, exports have allowed us to grow the industry, and I like that. Or the 3rd choice, dairy trade isn't the reason for our current low prices. So trade and exports certainly get a lot of attention when it comes to talking about dairy product inventories and dairy product prices. So kind of what is the feel of the audience? You know, are you in favor of exports, want more exports, or maybe wish we were doing a little less exporting? So we've got a really good audience in attendance, and I think we've got a good majority that have voted. So Jim, why don't you close the poll now? And we will let Dr. Stephenson talk about these answers a little bit.
Well, interesting. I've heard a number of dairy farmers expressing the fact that they wish we could go back in time, didn't want to export much dairy product. But, you know, I guess I would tend to agree with the sentiments that I see here. And that is that it's pretty hard for us to think about stuffing that genie back in the bottle. If we were actually going to get back to where we were before, we would have to get 10, 12% of our milk production and just take it off the market, have to quit producing it. That would be a tremendous bleed for the US dairy industry. So I'm not sure that that's a very viable thing. Exports have allowed us to grow. It's been good. I would say that it's also contributed to the volatility we've seen in prices out here. So maybe what you're telling me is I'll take the volatility but I do like the growth opportunities. And a fair number of people saying also that dairy trade isn't the reason for our current low prices. May not be all of the reason, but I do think it is somewhat related. And so we'll have to follow that and see how it is going to evolve for us. Let's get down to my milk price forecast. When I kind of put all the information together and try to synthesize the things that I think are going to be the leading movers of prices next year, I'm feeling pretty optimistic that we're going to see milk price improvement. I don't think it's going to be a 2014, but as we start to get more of that skim milk powder off the marketplace from the European Union, class 4 prices have a chance to increase, and I'm already showing them increasing quite a bit. In fact, skim milk prices right now, it's unusual but not unheard of, are well above class 3 prices. I've got them converging a little bit more as we get further out into 2019, but still staying above class 3 prices. We, for our part, have to find some sales for cheese. If we can do that, then I think all of this can come together. All milk price is showing the response as well, but it's some combination of the class 3 and 4 that I've been talking about here. Let me put a couple of these things maybe into words. I've got some other contributing factors out here. And on the positive side for prices, we're slowing US and world milk production. That's helping us be optimistic about what's likely to happen with prices. We've got declining world stocks. We've had a relatively strong domestic economy out here, and we've had trade improvements in the last several months. I'm also going to put out here as a positive for us, El Nino. And I'll talk about that just a bit more in another slide or two. But there are some negative factors too. New Zealand's had strong milk production this year. That's helping to keep current dairy product markets refreshed around the world. We've had slow GDP growth in countries like China. We would consider it enviable growth, but they've declined from 8, 9, 10% growth to 6% range. So even though there's a lot of room for additional consumption in China, it may be that their economy is going to make it a little more difficult for that to happen. And these prolonged trade negotiations, boy, they have not been good for us, in my opinion, and it's been difficult. Maybe long term it will be okay, but short term it's been a bleed. And I put down here the bottom with what I started with, the possibility of a US recession. If all this dairy product has to stay in a US domestic market to clear, it's not going to be a pretty picture if it has to clear in the face of a recession. So I'm really hoping that we put that off for just a little bit longer and maybe forever, but I don't think that's likely. I talked about El Nino. El Nino is that warm weather or warm body of water that we get in the Pacific Ocean. It forms periodically every few years. And when that happens, it does impact our weather across the continent. This is what the National Oceanographic and Atmospheric Association shows as a normal kind of outcome for us with the El Nino that actually is formed now. It's not just 90% chance of forming, and it may strengthen. And that is quite a bit warmer temperatures in the northwest part of the country and milder here winter in the upper Midwest. And we've seen that. It's been a milder winter this year so far. So temperature is part of what we see. The other part of what we see is a change in the pattern of precipitation. Usually it's quite a bit wetter through the south and the southeast of the United States and drier in areas like the upper Midwest. And we've seen some of that as well so far this winter. It has been slightly warmer and drier for us here in the upper Midwest. Not bad for milk production in this part of the country if prices would support it. So here's my forecast. Unless circumstances change significantly out here on the export side, I can't be overly optimistic, but I think that we're seeing enough strengthening happen here to give us some milk prices that will feel better. I don't think we can feel good until about 17 or 18% of milk production on a rolling 12-month average is achieved. I'm forecasting this 2019 Class 3 price to be up by an average of $1.10 over the year, Class 4 up by quite a bit more than that, $1.80, and the U.S. all milk price to be up by $1.15. That reflects weak premiums. The all milk price is not just the minimum prices to be paid, but what it actually was paid to get milk in the door of plants. And the surplus that we've had in milk production has met resistance, and we've seen some weak premiums in a good part of the country. Basically, I think 2019 is going to feel about like 2017, maybe not quite as good, but close to it. We're losing more farms in the country, but not our capacity to produce milk. And so that's kind of keeping ahead on this. And I guess I throw out a question here. Is this the new normal? Well, I hope not, but you know, this feels a little different to me. It feels like we were on trend for decades with little wiggles in the line, but this feels like a bigger one. I think that this is going to look back and in time and say this was a changing point for us, an inflection, if you will. So with that, I'm done, but I would be happy to answer any questions that people might have. And I think we actually had a couple that were sent in ahead of time, and maybe I can move on to one of those.
Sure. Why don't you just let me do a few things here, Dr. Stephenson, and then we will go on to the questions. So thank you very much for that informational presentation. I know it's hard to look into that glass ball, but I think you gave us a great update of what's going on out there and then some of your predictions for the year ahead. I think the good news for everyone listening, and you know, we think that too here, is that there will hopefully be improvement in the milk price this year, even if it's not a substantial change. If things are looking up, I think that's something that we can all appreciate, and will hopefully make 2019 a slightly more comfortable year for our dairy farmers and the dairy industry as a whole. I also want to give one more thank you to Christian Hansen for their support of this program. We appreciate the industry partners that help us sponsor these webinars each month. If you would like to listen to this webinar again or share it with somebody else, or if you would like to check out one of our past webinars, you can find them all on our archives. They appear on our website at www.hoards.com/webinars, and there you'll find our entire library of webinars that we've done over the past 8 years. I want to invite everyone to our upcoming webinars that will be taking place the next few months. In February, we'll be looking ahead to those warmer summer months and talking about heat stress. And there's a lot of interesting research that has happened down at the University of Florida focusing on how heat stress not only affects the upcoming lactation for a dry cow, but also the milk production of her calves and future generations beyond that. So please make plans to attend that webinar in February, and TechMix will be the sponsor for that program. And then in March, we have a little bit of a different presentation where we will have a dairy producer and their veterinarian talking about their reproduction on the farm. They're a Dairy Cattle Reproductive Council award winner, so they certainly have done a lot of great things in the area of reproduction, and we'll have some great insights to share. So please make plans to attend that. As Dr. Stephenson mentioned, a few questions came in ahead of time, and then some of you have asked some questions during the presentation. So we are going to go into that part of the program right now. So the first question here came in advance from a gentleman named Scott. He says, since soft drinks and fruit juices are under attack for their high sugar content, what is the main market competition for milk these days? Is it bottled water, or is there something else out there that's taking away some of our milk drinkers?
Well, that's a good question. And, you know, certainly bottled water is a fierce competitor with milk. We've also seen a variety of other things, fancy waters, or, you know, like vitamin water, coconut water. But, you know, people are drinking more now, not for nutrition so much as they are for refreshment. And I think that this whole suite of beverages that we have has been a major competitor for us for milk. When I was growing up, my mother used to say such things as, drink your milk, it's good for you. Well, we're probably the first society that's ever had the opportunity to have an obesity epidemic. I don't need any more nutrition. So I don't drink milk for the nutrient content, even though I know it's a healthful product. We drink it because, we're looking for some kind of beverage and refreshment. So I think that most all of the beverages are a key competitor in this particular branch of beverage. Other dairy products we're consuming, though, not for beverage purposes, but because we like them or because of their nutrition.
Very good, thank you. I think there's another question on the next slide.
Okay.
From Scott again. I've noticed some markets have stayed with whole chocolate milk and dropped the low-fat varieties. Is this strictly due to market demand, or is there a higher cost to producing low-fat flavored milks and just low-fat milk in general?
Well, from the standpoint of the technical aspect of producing it, no, it's not harder, because one of the first things that happens to milk when it comes into a plant is that it gets separated into skim and cream. And then we put the amount of desired cream back in to make the final fat content of 2% or whole milk. I think that what we've been seeing is that the full fat milks, the whole milk chocolate, has been being consumed because people like the taste and flavor of it. And this is the large reason that full fats in almost every dairy product, including yogurts and other things, have been much in demand. They like the flavor. And when our medical community declared truce on animal fats, the population in general just said, thank you. I prefer full fat dairy products. So that's why we've seen that be more costly. And low fat milk is not more costly to produce.
Good to know. Thank you. And then I am going to go through some of the questions that came in. So we always like to call this a speed round and let you answer these questions that people had while you were presenting. So, and the first question here is, where do you see the export market going? I know you talked about exports, but what % of U.S. dairy products will be exported in the next 5 years, in your opinion?
Well, USDEC, has a new goal where they would like to see the next 5%. They would like to see us up around 20%, of our products exported. I think that's altogether achievable. We've had that kind of trajectory. We can produce plenty of milk and dairy products. If the world has the economies that support purchasing them, then producing them is not going to be a problem. Other countries, New Zealand is a good example, are kind of hitting the wall in terms of milk production. They could produce more, but frankly, they are at a point in time where they don't want more animal units on the land. It's become an environmental issue for them, and I think we see some slowing of growth there. The various countries of the European Union could produce more milk, but I think we've got a good role to play in there. So exports, I think, will increase.
The next question is, will the new NAFTA be approved by Congress? Any comments on that?
Oh, I think it will. It's too important for us not to do that. I know that we've got all kinds of reasons for political posturing and wrangling, but frankly, I think when you look at much of what we have in this USMCA agreement is kind of getting us back to where we were. It's certainly true for a lot of agriculture, but there are some new sections of trade that were non-agricultural where there are improvements for the U.S. And I'm pretty sure it will be ratified. It's a matter of time. I would hope that would happen sooner rather than later.
Very good. The next one, kind of a comment with a question. This person has been in the supermarket and just kind of noticing the wide variety of choices that are available: low fat, no lactose, high protein milk. While it's nice to have so many choices, do you think there's too much variety in the milk, kind of in the dairy aisle, or is this a good thing for us?
Well, usually economists would say choice is good, and that's what consumers want. But we've also had plenty of evidence over the years that too much choice can overwhelm us. I'm curious sometimes when I go in, just look at all the variety of things, because yes, we do have quite a lot of stuff in the dairy case anymore. But I will also say that the dairy case has kind of squashed a lot of our facings down to a smaller set of lineal feet that we have dairy products on, and we are seeing more refrigerated products that are non-dairy in that traditional dairy case section. But it can be confusing to consumers, but I think we're finding all the things that we want in there. At some point in time, we're probably going to have to cull our choice set in there if it gets more complicated than what it is. But in general, consumers want the chance to explore some new ideas. And dairy products are different. If you haven't done it before, take a taste testing of even milk products and see which ones you like best. They don't all taste the same.
Very true. This question is coming from someone, it might be hard to give a very detailed answer, but maybe you could summarize briefly. Given the passage of the new Farm Bill and the new Dairy Revenue Protection Program, what would you do as a dairy producer to take advantage of those programs?
Well, I'll tell you what. I think that the new successor to the Margin Protection Program, the Dairy Margin Coverage Program, is something that's too good for producers not to look at. There's going to be plenty of information out and available by the time we get to sign up period, and everybody should take a look at it. But having the ability to buy up above that $8 level on tier 1 to go all the way up to $9.50 means that it will trigger quite a bit more. Over the last time of the Farm Bill, the period from 2014 through the present, we would have had an MPP margin trigger 2/3 of the time if we had a 950 protection on that. And the other thing they did, of course, was to lower the cost of the premium significantly. At 950 in tier 1, it's only 15 cents. That is really good basic coverage for dairy farms. Even large farms can take advantage of that now, because we can go down to a smaller percentage coverage. If you are larger, you don't want to buy much in the way of tier 2 unless you're buying it only at the very lowest catastrophic coverage levels. But even at the $5 level, it's only a half a penny, a hundredweight in tier 2. And at that kind of coverage, I think you can look at this and say, that's not bad catastrophic insurance, not terribly expensive. So I think dairy got a pretty good deal out of the Farm Bill this year.
Glad to hear that. Next question. Do you have any data available or know what the average herd size is for farms that are able to cash flow right now? Is there a certain size farm that's doing better in this economy?
In general, we will look back during this time period, and you see that the larger farms have a tendency to be lower cost producers. But, if we segment our dairy farms up into different farm sizes, one of the things we see is that the top producing farms in every herd size segment tends to have about the same average cost. It's just that the range is quite a bit larger on the smaller farms. And so I won't say that, there's only one size that is really cash flowing well, but our larger farms in general tend to be farms that have probably been better managers overall. And that's certainly not true that they can only be better if they're bigger, because we do see those smaller farms that achieve the same kind of cost levels of production. So it's a smattering of all kinds of farms that have cash flowed through this.
All right. The questions keep rolling in, but I think we'll answer a few more here. Do you think that the federal order formula needs to be looked at, maybe reconsidered?
Personally, I do. I think, it's a no-win kind of situation for federal milk marketing orders, largely because nobody's happy with them, but we aren't really sure that there's anything that we could do that would be better. we may be able to examine milk price discovery and see if there's another mechanism that works. But as long as we're using product price formulas like we have, those have to be updated from time to time. Costs do change. I mean, the cost of utilities and labor and everything else will change over time. The cost of technology changes and tends to help reduce those costs. So we need to look at the make allowance issue on federal milk marketing orders. It's been a decade since they've been changed.
Next question. Do you think staying in the Trans-Pacific Partnership would have altered our current dairy situation?
No, I don't. I don't think that that was a bad partnership, and I'm kind of sorry we jumped out of it, but that would have helped us more in the future than it would in the present. So I think that being in the partnership now would not have helped us all that much. But, you know, we are now going to have to start negotiating maybe bilateral negotiations or maybe small multilaterals with 2 or 3 countries to get back into that trading block. We did give up probably a position that wasn't too bad. What we got in the way of our opportunities with Canada under the USMCA was probably fairly similar to what we would have had under the Trans-Pacific Partnership.
All right, switching a little bit to processing here. Do you see an increase in activity by the industry to upgrade or add more manufacturing capacity?
Sure. We've had plants that have been building capacity all along, in many cases adding to their existing operations. But we've also seen some large new greenfield operations going in. Michigan has been kind of the poster child for needing more capacity. And they've recently got a couple of plants that are breaking ground. One of them, a milk concentration operation. The other is going to be a very large cheese manufacturing operation in the central part of the state. So there are new plants that are being built and capacity that's being added.
That's good to hear. With the new farm bill and some of the new programs, do you think it is going to help keep more farms in business that were potentially thinking about selling out prior to this?
Well, possibly. But I think that a lot of people, you know, have been at the point in time where they're looking at either having to borrow against their equity and making the decision to step out of milking dairy cows right now because that didn't make sense. They just simply didn't have enough time to pay that back and into a retirement situation. And for those folks, it's probably not going to happen quickly enough. But for smaller farms in particular, I think that the new Farm Bill program is going to be fairly generous. And I would really encourage people to look at it and see if it makes sense for them to take advantage of it. So yes, I would encourage people to look at it.
All right. Well, I think we need to move on now. That was a large amount of questions that came in. So thank you everyone who asked questions. And thank you, Dr. Stephenson, for going through them and being able to cover such a variety of topics in a short period of time. Overall presentation, once again, you did a great job. I think this was a very good way for us to kick off our 2019 webinar season and appreciate the insights that you could provide to all of our audience members. Again, thank you to Christian Hansen for supporting our webinar. If you want to learn more about them and their products, please check them out online. And last but not least, I want to thank all of you in the audience. We really appreciate it when you attend our webinars and hope that we're able to provide you some information that helps you either on your dairy farm or with the clients that you serve. We hope that you will plan to join us again for one of the future webinars. So we're talking about heat stress in February and then reproduction in March. So a variety of topics are coming down the pipeline. Until next time, I'd like to say goodbye from all of us here at the Hoards Dairyman office and our team at the University of Illinois. We're always glad to have you on board and we look forward to talking with you again in a future month. Thanks so much.